Hello and welcome to Auto Trade Signal's instructional video series on using machine learning tools to improve your trading. This will be one of the first instructional videos that we have, and we'll be talking today about indicator filtering. Now, we don't usually use or hear this term because it's something that's fairly new that we've developed, but we think that it's something that's very, very important that will be able to help traders make their trading simpler, more effective, and easier to understand when you should and should not trade. Keep in mind that during the instructional video today, we won't be making any recommendations for what to buy, when to buy, or things like that. You trade the system and strategy that you're comfortable with. You buy and sell what you want. We're not asking you to change the way that you do trading. What we're getting at today is how do we make the trading that you're doing easier and more profitable. Machine learning tools are used to simplify and empower traders. These are not an additional indicator to plot on the screen or an additional something to interpret, but it's something that will help you bring insight into the trading that you're doing. We're going to be using a lot of data analysis and show you some results today for different stocks and trading methods that I don't think you've probably seen anywhere else before. Our ultimate goal is to make things simple, intuitive, and ultimately more successful. So why do we use indicator filtering? Well, trading systems often use several indicators to make trading decisions. But are all of them really relevant to the instrument at hand? We don't usually think about this. Normally people research and develop or purchase a particular trading system, and the system comes set with a group of indicators that the trader uses to interpret, and they use the same group of indicators for everything that they trade, whether it is futures, stocks, options, all of that. The thing that we don't realize, though, is that some trading methods may be negatively affected by non-informative indicators. We don't often think about how effective each one of the indicators we're using is to the trading that we're doing. Many times, indicators often relay similar, or what we'll call correlated information. So you don't gain any insight by the additional technical indicators. In other words, sometimes the information on your screen is redundant. In removing unhelpful information, the tool that we'll talk about today is primarily focused on removing the information that doesn't matter to your trading. Again, our goal is to simplify trading and in the process perhaps increase accuracy. If we can reduce the clutter of information on your screen that doesn't help you be more successful, it's oftentimes easier to interpret the information that's on your screen. The human brain is very, very good at interpreting visual information. We interpret visual information about 60,000 times faster and more efficiently than we do written information, where you have to read it, interpret it, picture the information in your mind. In other words, turn the words on the page into a visual picture. Why not just put the visual information on the page that is essential to making the decision? The presence of non-informative or redundant information can also add uncertainty to the trading process and reduce the overall effectiveness of your trading. And we've seen this many times before. What will happen is 3 of the 4 indicators will be positive for a trade, but one of them won't quite be in the area that your strategy says take the trade. So what do you do then? If 3 of the 4 are agreeing and say take the trade, but one is disagreeing, do you pull the trigger and buy? Do you not? Do you stay out of the trade and then watch it later go into your favor? And so this is one of the things that causes a lot of frustrations with trading, and the reason why sometimes people are so inconsistent. The other thing to keep in mind is that simpler trading models and systems tend to hold up better over time compared to more complex models. What I mean by that is that often have you ever had a trading strategy that started out perfectly fine? You were being profitable with it, and then later on the strategy simply broke down. Well, what was the problem there? Did the underlying assumptions of the model all of a sudden no longer hold true? Or perhaps did the model include information that wasn't entirely central to the trading style that you're trying to implement, and that unhelpful information basically broke your system? So you can have a good strategy include unhelpful or unimportant information, and sometimes that information can actually undo the effectiveness of a perfectly good strategy. Here's an interesting thing that nobody does very often. Maybe a few people, but not very often. And this is a very simple way to approach the kinds of analyses that we're doing. Many people are familiar with backtesting and the backtested results of your strategy, not as a promise of future performance, but just as a way to validate that your trading strategy is in fact has the potential to be profitable. But what if you redid the backtest of your strategy, and each time you performed the backtest, you removed one of the indicators that you were using? If you remove this, essentially what you're doing is you're measuring the effectiveness of each one of the indicators that you have. Now, obviously, if you have only two moving averages and you trade a moving average crossover, all of a sudden you don't have you don't even have a signal. But let's say you had a trading strategy that included a short lag moving average crossing over a longer time lag moving average, let's say a 10 EMA and a 50 EMA, and you took a long trade every time the 10 EMA crossed above the 50 EMA. But you only did that when the ADX was above a certain value. What would your trading system do in terms of the backtest if you simply removed the requirement for the ADX value? Does it improve? Does it go down? In other words, what's the value of that directional index indicator to your strategy? We don't often approach evaluating trading in this way, but it can oftentimes give you an insight or some key information about how valuable each of the indicators is to your strategy. The value of each component is something that you'll want to be aware of. And most traders are completely unaware of what drives their success. I would be willing to bet that in the moving average crossover simple strategy that we just mentioned, that if you remove the ADX indicator from the strategy, on some of the instruments, on some of the stocks, it actually wouldn't make a difference. On other stocks, it would make a tremendous difference, and in fact, the strategy would improve dramatically. On other stocks, it would actually have a negative impact. So, in other words, trading only when the ADX was above a certain value would be a very important component of the model for those stocks. And so, we don't always look at the value of each one of our indicators, but we really want a way to prove that each one of the things that we're trading is actually very impactful or important to the underlying stock. And we'll take a look at some examples here shortly that I think will be surprising. So what is indicator filtering? Well, indicator filtering essentially answers this question. Is there a meaningful relationship between the technical indicator and the price of what you're trading, whether it be futures or stocks, even currency? Do you know for certain that the indicator that you're using has a meaningful relationship with the price of whatever you're trading? Because if it doesn't, you have to step back and ask yourself, what is the nature of the information from this indicator? Why do I have it on my screen? Why am I even paying attention to it? Or is it cluttering the view and making your trading decisions more difficult? Because if it's not adding information, what it is adding is potentially confusion and background noise. And it potentially can be one of those things that makes our trading less profitable because it adds a degree of uncertainty. This is a great graphic to show and illustrate a point of exactly what I mean. And I really love this picture. This is a plot of the number of Nobel laureates per capita or per population plotted against the amount of chocolate consumption per person. Okay? And what we see here is a really strong, very clear relationship. It's very statistically significant that shows the more chocolate you eat, per capita, so the closer to the right-hand side of the graph, the population density of Nobel laureates in the population of that country goes up. So what you might be tempted to, if you were going to build a model that predicted the number of Nobel laureates in your country, is to simply measure how much chocolate per capita that country consumes, and then build a model that would predict the number of Nobel laureates per 10 million population. And you know what? It might be fairly accurate, at least for this group of countries right here. But you add a different group of countries and your model all of a sudden doesn't work at all. And that is a great illustration of a very important piece or a very important idea in technical analysis. Step back just for a minute and think about the nature of the relationship between winning a Nobel Prize and how much chocolate your neighbors eat. It doesn't really make sense, does it? And yet the graph shows that the two are related. But being related is very, very different from one causing the other. And so it doesn't take much deep thought to realize that probably the amount of chocolate consumption and whether or not you have a bunch of Nobel Prize winners in your country probably aren't directly related. In other words, eating chocolate does not cause you to win a Nobel Prize. But the graph seems to imply that perhaps there is. And we see this all the time in trading. We'll see a new technical indicator or strategy come out, and the educator will show graph after graph after graph of, look, this is where it happened. Look, this is where our model was successful. Oh, look, here it happened again. And sometimes they are shown at random, and sometimes the examples are handpicked to be best case examples of when that particular relationship worked. But when you think about it, if you have a hard time understanding why that would be the case, maybe it's just an unrelated circumstance. Let me show you another picture of a similar kind of example. In this picture, what we have is another plot that shows the number of researchers per million people in the country plotted against the annual coffee consumption per capita. And again, we have a great relationship. It has a very, very easy to see linear relationship that goes from 0, 0 down at the bottom left, and as you go to the right, it increases along the way. Again, a very strong relationship between the number of researchers a country has and the amount of coffee per person that is consumed in the country. And yet again, if you step back and you think, well, why would drinking more coffee produce more researchers? And in fact, it may not. If you look at the graph and you take a look at only the top half of it, what you would see is the top half of the country. In other words, the ones that are have the most researchers per million inhabitants, which also happen to be the countries that also drink the most coffee. Well, all of those countries are in colder northern climates. And so maybe it has nothing to do, the number of researchers has nothing to do with how much coffee that you drink. but coffee is consumed already in those places because the climate is simply colder. And so we have to be careful about the way that we interpret indicators and the impact that it makes on prices. Which technical indicators have a plausible relationship with the stocks that I want to trade? This is the question that you should be asking. Said a little bit differently, which technical indicators are the most powerful predictors of price outcomes? If we're looking for price to go up, which indicators would also indicate or show or predict that particular price move? Same thing with the downward move. If I'm looking for price to go down, which indicators are going down? If price is going sideways, which indicators are also not moving much? These are the things that are helpful and important to us as traders. And I want to give us a couple of examples here. The output that you see, the white graph over here on the left and the one on the right, is an output from our indicator filtering tool at autotradesignal.com. It will be going live here pretty soon. And we're comparing, what we have here is a list of indicators that are most related to price outcomes. And we have two stocks that we're looking at. GM is on the left and Ford is on the right. Now we've paired these two up because I just want to take a look at the indicators for each one. They're both from the automotive industry, and in fact they both sell very, very similar products. And you would think that the economic indicators or the economic factors that influence General Motors would also influence Ford in the very same way. But what we see is that if we look at the graph on the left, the General Motors listing, these are listing of the indicators that are most related or most informative to what will happen to price. Will price go up or will price go down? And they are listed in a specific order. The most important one is listed at the top, the second most important one underneath that, and so on. And so what we see for both General Motors and for Ford is that the volume of the stock is most predictive of whether the stock will go up or down the next day. And so if you are trading a strategy based on price action, for example, volume and price, that particular strategy is likely to work quite well for both GM and Ford because the most predictive value or indicator is in fact volume. But look at the list as you go down. As you go down the list, the indicators become less and less pertinent to deciding whether or not the stock will go up or down the next day. For GM, the opening value of that bar will tell you whether or not the price will go up or down the next day. The next one is the CCI. But wait, look over at the Ford picture on the right. The CCI is next to the bottom, meaning that for trading Ford, if you have a strategy where you're trading some related industries to Ford and GM, the CCI might be more helpful for trading GM and less helpful for trading Ford. And in fact, if you go on down the list, the gm.close.ema.9, that's actually the RSI value for GM. It's about middle of the list. But look over on the right side. It's the second most helpful thing behind volume for Ford. You go on down, about 2/3 of the way down on the GM list is unbalanced volume. It's a very popular indicator that kind of combines price and volume. But you'll notice unbalanced volume is missing from the right side list. It's not even included in the top 11 things that are most impactful for trading Ford. So if you have a strategy that uses an OBV line for trading GM, yep, it's probably adding information to your trading, but it's much less important for trading Ford. even though the two companies are from the same economic category. Let's take a look at a couple of more. Here we're going to the tech world, and we're going to compare Facebook on the left with Twitter on the right. We see the open and the volume again are pretty important for Facebook. The volume of Twitter stock is important on the right. But then things begin to change quite a bit. After the open high volume, the signal line from the MACD is there on the Twitter side. Then we have the ADX, the average directional index, about halfway down on Twitter. But you'll see on the left side for Facebook, very, very similar company in terms of the economic impact and the area in which they operate their business. The ADX isn't even included for Facebook. We have true range, we have the CCI, and we have the SMI. Barely makes it in the bottom there for Facebook, where the SMI is much more helpful for trading Twitter. And again, these two things are very, very similar. They operate in a very similar economic sector, but the impactfulness or the importance of different indicators are sometimes very, very different. Let's take a look at a last pair here. On the left, we have Valero, and on the right, we have ExxonMobil. Again, two companies from the oil and gas sector, two companies that do something fairly similar. And so you would think that it would be related in terms of what things you could use to trade, which indicators you could use to trade them. If you look at the right, we see again volume is very important. Close.EMA.9 is the 9-period RSI, very important for ExxonMobil, as is the open and the high. And so if you're trading a price action strategy or you're trading the RSI, it's likely to be fairly helpful for you for ExxonMobil. But take a look on the left. The list of indicators that are important for trading Valero is completely different. In the Valero side, we see no indication that volume is all that helpful in terms of predicting whether or not price will go up tomorrow or not. We also don't see the RSI, we don't see the high, we don't see the low, the open, the close. So basically, if you're using a price action type of strategy on Valero, it's likely to be much less successful because the information you're using to trade isn't as impactful, or it's not as good of a predictor of what price is likely to do tomorrow. And yet we look over here on the right, in ExxonMobil, that's some of the most helpful or most important indicators for helping us determine what price is likely to be doing. On the left side with Valero, we see the directional index, the average directional index. We see on balance volume. The ADX and the OBV line are completely missing from the ExxonMobil side on the right. And so here's a case where, again, two companies from the same sector doing essentially the same thing have prices that react completely differently to the technical indicators that we would use to trade. And if you're putting together a portfolio of stocks, what we would normally be inclined to do is perhaps include these two companies in your portfolio. They're fairly large companies. They're all part of the S&P 500. They're in the same sector. The same economic indicators are likely to affect both of them in similar ways. And yet, when we look at how indicators influence or how indicators pair up with prices, we find things that are sometimes surprising. So even closely related stocks from the same industry do not always show the same relationships to the technical indicators that you may use. So be careful with how you choose to trade groups or portfolios of instruments. The same strategy may not work equally well for every company. To help traders through this sort of surprising revelation of how technical indicators are related to price, we're releasing several tools for traders in the future. The first one is the indicator filtering, which simply asks the question, which indicators share information about a stock's price? When we release the worksheet, or whenever we release the website here in a few days, after people have had a chance to view the video, all you would do is you would enter in the stock ticker, and it would tell you what are the indicators that are most impactful or most important for this particular stock's price. You want to know each one of the stocks in your portfolio, or the instruments on your watch list. You just type it in, and it'll give you a rank order list like that of what is most important for you. After that, sometimes people would sometimes say, I have a trading strategy that's based on price action, or I have a trading strategy where I only trade and go long whenever the ADX is above 25 or above 30. Well, in this next tool that we'll be releasing later, you can type in the indicator name, and it will go through a list of stocks, and it provides you a list of stocks where that indicator is also included in the top 5 or 6 or so technical indicators for being informative about the price. We'll also be releasing a tool that will give you a price level target. In other words, where's price likely to land tomorrow? And lastly, just a broad sentiment profile of the market. What is the market feeling like right now? What is the information that we're gathering saying about the different markets, the S&P, the NASDAQ? Are they generally in a good mood or a bad mood? If the market is has some negative connotation, obviously sometimes for different stocks it pulls that stock right along with it, and so we would want to be aware of that. And so this is a list of tools that we will be releasing in the coming weeks to help traders use information to make their trading simpler, know what's important, and perhaps put together more intelligent portfolios or groups of stocks or options on their watch list that are related to the indicators that they are already trading. So that's been our first walk through indicator filtering. We'll be releasing, we'll let everybody know when the website URL is ready for testing and ready for inputting your different stocks and seeing just what indicators are helpful with that particular stock. I hope this has been informative for you and helpful. If you have any questions, feel free to email me directly. My email is there at the bottom of the page here, and we'll see you very soon. We're going to come out with a couple of shorter videos that show basically the indicator filtering in action and how you might use it to help your trading.